Dollar General is down a whopping 53% year to date. Are we looking at a significantly undervalued company with massive room for growth, not only on that share price, but also on the forward yield of 2%? Can we see this share price doubled along with this yield on cost at least high single digits over the next few years? Let's find out in today's episode. We're going to look at the historical performance of Dollar General Corporation. We're going to dive into their financial statements, their income statement, looking at their essential top line revenue growth year on year, as well as that important bottom line net income. We're going to dive into the health of their balance sheet, take a look at their total cash versus their total debt. This in turn is going to lead us into that all important dividend safety of the company, as well as some very strong financial metrics that we need to interpret if we are to invest in Dollar General. As always, we are going to run it through our valuation model, getting to our intrinsic value and our acceptable buy price given our margin of safety. Now it's down a huge 52% year to date, right there at that 52-week low with a yield of 2%. Now, shareholders who have been holding the company for at least 10 years would still be up a strong 104% without those dividends reinvested. As we can see, it was at one point $260, so it has dropped more than half. So is this a case of market reacting in the negative way, and do we have opportunities for significant growth on that share price appreciation as well as our yield on cost in the future? Well, let's take a look at the business, the income statements, their revenue in particular. When we take a look at that top line, we like to see 3 to 7% growth year on year. February 2019, 25.6 billion on that top line. What do we see when we take a look 5 years later? February 2023, 37.8 billion. So strong growth, in fact, over the 5-year period. On a more granular level, what do we see? Well, what we see are consistent increases year on year, and we will shortly take a look at that 10-year growth in terms of percentages too. In terms of the bottom line, net income, how does it shape up in comparison to the revenue growth? Well, 1.59 billion reported February 2019, 2.4 billion in February 2023. So again, nice increase over that 5-year period. On a more granular level, a slight different story. We see an increase from February 2019 to 2021. However, there is then a small drop in 2022, which is then picked up again. So a slight inconsistency, but so far a strong income statement in my opinion. Now, in terms of the balance sheet, and more importantly, the cash, what do we see? Well, they held around 236 million in 2019. Latest quarterly report showing an increase in their cash to around 353 million. Now, how does that compare to effectively their total debt, both numerically and directionally? Well, total debt we can see here, 2.86 billion in 2019, a huge increase in their latest quarterly report to 18.035 billion. So that is a huge increase, and this raises a red flag. It's a red flag indicator. Let's take a further look. So straight away, dividend safety score 64, meaning it is safe. Market cap 26 billion, making a large cap company. Now, quickly, for those who believe we're heading into a recession, well, the last recession, they did in fact cut their dividend in the 07-09 period. The 07-09 period, in terms of sales, they had plus 3.5%, which is positive, especially when you consider the average growth rate for the S&P during this time was in fact negative. So a few things to consider there. Now, they have been paying increasing dividends for the last 7 years, very, very positively. 7.3% increase March 23. Last 5 years, 16% compounded annual growth, very positive, double digits. Again, 18% over the last 20 years. So far, I'm liking what I'm seeing. 7.3%, why do I like this? Obviously, these are very strong percentages, but this is above 4%, which I always look for in my dividend growth, salary growth, as well as other income-producing assets. Why? Because the US inflation rate over the last 40 years was 4%. Theoretically, if you are taking anything less than 4% year on year, you are losing your purchasing power and taking a pay cut. Now, dividend yield theory states that a company is undervalued when the current yield sits above the 5-year average, 2% versus 0.86. This is showing signs of severe undervaluation. However, as always, we never look at any model in isolation, and we'll draw conclusions towards the end of the episode. Likewise, 15 forward PE versus a 21 5-year average, another sign of undervaluation. We can also see the PE of Dollar General at 14.9 versus the sector PE at 21.3. And as I mentioned, right there at that 52-week low, but as I always repeat in each video, 52-week low does not signal undervaluation. Likewise, neither does 52-week high signal overvaluation. Earnings, I tend to ignore this. It is susceptible to manipulation by management. Free cash flow is what I look for. Below 60% is my preference, as it means, in my opinion, management are able to increase that dividend to double digits that we love to see as dividend growth investors. Now, up to 2022, in fact, it was below 30%, very, very positive. 2023, this is a red flag indicator. Why? What does it signal? Well, it's showing us that 117% of free cash flow generated was paid out as dividends. So they are paying out more in dividends than they are generating in free cash flow. However, one thing that does make me slightly happier is that it is expected to drop in 2024. But this is a slight red flag indicator, more so for that dividend in my personal opinion, which at the moment looks to be safe. Likewise, earnings per share, I just really quickly glance over, but it is there for those investors that like to take note. Free cash flow per share, $2.09 in 2014. It has dropped to $1.88 in 2023. Before that period, it was going up quite dramatically, as we can see. It then has come down from 2021. However, 2024 is expected to go up to $4.72. Not the greatest, but again, this is a company that has year to date been down 53%. So again, we can see why we are seeing some cracks in the armor. Now, sales growth 3 to 7% is what I love to see for businesses. Very positively up to 2021, they were doing exactly that, if not better, year on year consistently. It does go to show that just because companies are performing very well year on year, that there isn't something around the corner. As we can see here, it has dropped in 2022. And 2023, it has picked up again. So very positive overall, in my opinion, over the last 10 years. More than doubled their revenue over the last 10-year period. $17.5 billion in 2014, $37.8 billion in 2023. Now, shares outstanding, another thing that this company does very well. They do share buybacks, essentially returning excess cash to the shareholder pockets. $324 million in 2014, $226 in 2023. Very positive, and it is also a big green tick when you consider that dividend growth, as we saw effectively when we take a very quick look. Very high single digits and then double digits over the period. So lots of positives in my personal opinion so far. ROIC, one of my 7 golden dividend metrics. Check the pinned YouTube video to see the other 6. 10% plus is what I personally look for, as it means management are able to effectively allocate their capital. Looks very well over the last 10 years. It has come down from 2019, but if it can at least at a minimum maintain around the 14-15%, very, very strong in my opinion. Operating margin and free cash flow margin, we can see the operating margins, whilst we like 10% plus, what we can see is it has consistently been around 8 to 11%. Not the worst, but I would like this to pick up. However, as we can expect, this looks to be something that they may struggle with continually due to the shrinkage and the theft that they have had in their stores over the past few years. Free cash flow margin, as we can see, again, 6% plus for consumer retails. They haven't really hit that mark. However, up to 2022, it was between 5 to 6% for the most part. So as long as they can maintain that in 2024, as we do see this huge dip in 2023. Finally, net debt to earnings before interest, tax, depreciation, amortization. What we like to see is a maximum of 3 being the number of years it would take the company to pay off all their debt net of cash on hand. What we can see, in fact, it has essentially been hovering around that 3 for the last 10 years. 2023 at 2.89, 2024 expected even higher at 3.32. So there are some things you do really need to take note of this company if you are looking to invest, because there are some very strong positives that we have run through, but there are also some red flag indicators that you need to follow up on as an investor. And here we're purely saying that in 2023, 76% of the company's financing was from debt as opposed to equity. As always, if you are enjoying the content, hit that like button, smash that subscribe button, and hit that bell button to be notified of these videos and to be delivered directly to your doorstep. Now, we're going to run through the valuation model. If you want to grab a copy of this model we're about to run through, do grab a copy in the pinned description below. Stock ticker DG with earnings per share at 9.76, growth rate at 6 per analyst estimates, with the current yield on AAA corporate bonds at 5.03. Giving an intrinsic value of around $111 when we take a quick look, not too far off the current trading price, showing potential signs of reasonable valuation based on Graham's valuation model. We then move on to the second model, companies in a similar sector and size. We have Dollar Tree and we have a Target. We have their stock price and earnings per share. This gives us our P multiples, of which you do the average multiplied by the earnings per share of Dollar General to get a multiples valuation model of $183.54, showing some strong upside to the current trading price and well within that 52-week range, showing signs of undervaluation currently. We then move on to the third model, the dividend discount model. We have the yearly dividends along that growth rate, which to me is very, very impressive. We can see an average growth rate of 15.5%, which looks incredible, with only a year ago they raising the dividend by 31%. Now, forward looking, I've gone for around 6.5%, again on the more conservative side. As always, if you do justify a higher or lower percentage, do grab a copy of the model so you can play around and see what your own model and intrinsic value comes to. However, based on the estimates and judgments we've run through, this gives a DDM price of $167. When we take a look, nice upside to the current trading price and well within, again, that 52-week range. Now to the final model, the discounted cash flow model, where we have the free cash flows of Dollar General year on year. Average growth rate around 3.2%, with analysts optimistically expecting around 7%. In conjunction with the discount rate, we get the present value of future free cash flows and terminal value. When we add that together with the cash, subtract total debt, we arrive at our equity value. Now, dividing that by the shares outstanding gives a DCF price of $120, showing that based on the discounted cash flow model, we are entering reasonable valuation. Now, on the final essential intrinsic valuation, it is the average of the four models we have just run through. And as always, if you do enjoy the content, smash that like button and do subscribe to join this lovely community. Now, based on our estimates and judgments, we are getting an intrinsic value of $145.50, showing some nice upside to the current trading price and again within that 52-week range. Now, given the current price is around $117, margin of safety, 10%, wide moat, strong financial metrics, good forward-looking data, would mean an acceptable buy price of $131, meaning a buy price right now. If you're looking for a higher margin of safety around 20%, again, you could argue a dollar here or there. It is essentially right now, based on these estimates and judgments, a buy with a margin of safety of 20%. If you're looking for a margin of safety of around 25%, you're looking for a buy around $109. Now, personally, this does seem to be one that I will be adding into my portfolio. There is some risk associated with this. We do have the theft and the shrinkage, but again, do bear that in mind that what we have run through is based on the estimates and judgments that we have discussed. If you do have any different ones, do check the model and run your own numbers through. Wall Street, what are they forecasting? Well, over the next 12 months, they believe the price to be roughly around that intrinsic value we've calculated, showing some nice upside to the current trading price. As always, let me know your thoughts in the comments below. Are you looking to add, sell, or are you purely on the sidelines with Dollar General? Don't forget to hit that like button, subscribe, catch you on the next episode, and have a lovely day. Take care.